Okay, good afternoon, all. I'm just going to give the attendees another couple of seconds to enter the room, and we'll get this underway. Fantastic to see some familiar faces, familiar names after all this time. Bear with me, guys. I'll share the slides, and we'll get this underway. All right, so good afternoon, traders. A very good afternoon. It's wonderful to be back with you again as we wrap up 2023 and look to unwrap 2024 for major developed economies. We, of course, as I'm sure you can understand, I'll not be able to touch on all aspects of developed countries in a single sitting. So the plan going forward is to try and assess some of the macro themes and technical landscape for the US and the UK, and I will also try to touch on Europe. But I will also we'll have to bear in mind time constraints. So look, first and foremost, from me and the FP Markets team, thank you so much for joining. And I would like to wish everyone a very Merry Christmas and, of course, a Happy New Year. For those new to the webinars, my name is Aaron Hill, and I am one of the market analysts based at FP Markets. Now, sound and visuals should be working fine. Any issues with this, please do let me know, and our friendly support team will try and get things back up and running. Now, in terms of questions during the presentation, I am open to answering these as we go if they pertain to the slide or the chart being presented. If not, we run the risk of diverging too much. But if it's something you feel a question that you feel that may require a more comprehensive response, please consider waiting till the end of the presentation, as we may clear up any queries or anything like that as we proceed. Now, a recording of this presentation will be available under the usual avenue, through the usual avenues. That will be available through the main FP Markets webpage. You can find that under resources, and also through our main web YouTube channel, FP Markets. So, as usual, disclaimer. Look, I'm not going to read through all of the text on the slide there. Suffice it to say that this is not investment advice. This is purely my views on the economy and the macroeconomy and the technical charts. This is solely an educational presentation, so please do bear that in mind. Now, a brief agenda for this afternoon. We're going to look at major market moving events, some of the major market moving events for 2023. We'll also look at how 2024 is likely shaping up, as well as we'll highlight and discuss some of the key markets, in my opinion, for the year ahead. And as I already alluded to, we can open the floor to a Q&A following this. Now, I'm just going to transfer things over to the charts. Just bear with me, guys. And we'll get this underway. So the first chart will be the US dollar index, which is a geometrically average weighted calculation of 6 currencies, which includes the euro, the Japanese yen, and of course the British pound. They're the three major currencies, including in the dollar index. So look, just before I touch on the chart studies, the US economy, I mean, it's been an interesting one for 2023, as I'm sure we can all agree on, and will remain a key talking point for the year ahead. Now, unless you've been hiding under a rock for the past few days, you will have noted that the Fed held the Fed funds target range at 5.25% to 5.5% for a third consecutive meeting. There was no surprises there. This was largely expected. However, the Fed holding the line did come with updated forecasts. Now, Fed officials now project three rate hikes. Excuse me, guys, 3 rate cuts in 2024, with a rate cut firmly off the table. As evident from the Fed's dot plot, which is part of the summary of economic projections, which accompanies the rate announcement, the Fed members forecast the Fed funds target range to be at 4.5% to 4.75% next year, or 75 basis points of cuts. Now, market pricing, nonetheless, it projects around 5 rate cuts by November 2024, or 129 basis points. Now, with the first 25 basis points rate cut fully priced in as soon as May next year. We also currently have, just check, we also currently have around a 70% chance of a cut being seen as soon as March, according to the Fed funds futures now markets. The economic projections from the Fed were also quite interesting. I mean, core PCE inflation fell from 3.7% to 3.2% for the year 2023, from 2.6% to 2.4% next year, and from 2.3% to 2.2% in 2025. Now, for the unemployment rate, we're looking at really to remain unchanged from 2023, 2024, and 2025. And this is from 3.8% in 2023, 4.1% and 4.1% again in 2024 and 2025. Now, real GDP was elbowed higher for 2023, as was expected, from to 2.6% to 2.1%. And in 2024, real GDP is actually expected to decline from 1.5% to 1.4%. Drop from September's projection from 1.4% to 1.5% for 2024. Now, you'll also note that 30 minutes after that, the release of the SEP, the Summary of Economic Projections, and the rate announcement, we had the presser. This is where Fed Chair Jerome Powell jumps up, and he really declared that the Fed funds rate is, and I quote, is at or near its peak level. And this really signals the end to one of the most aggressive rate hiking regimes in as many decades. And it really adds fuel to the fire that a Fed pivot is really nearing. So before we, just quickly, guys, so before we do dive into the technicals here, I also want to highlight the disinflationary environment the US is in right now. I mean, I'm pretty sure we're all aware of this, or we should be all aware of this. It's pretty clear, and it goes for many major developed economies as well. And disinflation essentially means that consumer prices are still rising, despite its label, are still rising, but the rises are slowing when compared with previous months. Now, inflation in the US is at 3.1% in the 12 months to November, which means inflation is 3.1% higher than it was 12 months ago in November. Now, every man and his dog knows that the Fed wants inflation back to target, the 2% range. But as I'm sure you can, as I'm sure you agree, this could prove difficult, which, look, I read that is now often termed from 3% to the 2% target, that it's often termed as the last mile by many central banks, using a metaphor to describe the challenge of reaching the inflation target. Now, for the US, this could indeed be a challenge, right? One that may really weigh on economic activity. And this really leads us on to growth, right? So growth in the US, I mean, really has been quite interesting and somewhat of an outlier compared to economies in the UK, Europe, and Australia. So economic activity in the US jumped to, I think it was 4.9% in the advanced estimate. And this was up from, I think this was, I'm just trying to check the details here, guys. 4.9% in the advanced estimate, but we then had the preliminary, or the second estimate, which showed 5.2%. And much of the revision was derived from business investment, according to the release. Now, you may recall that Q2 real GDP actually came in at 2.1%. Remember, though, guys, we do have the final estimate, which is the third estimate for real GDP, released on the 21st of September. So that will be Thursday. Look, overall, for me personally, I do not see much demand for the buck right now. I certainly see growth struggling to maintain its current trajectory in the new year, as the effects of more than 500 basis points of tightening are still taking hold in the US economy. Now, while I'm unsure that we will see whether we'll see a recession in the US, which, if you think about it, really is quite remarkable, given that we are not already in a recession, given the tightening, the monetary policy tightening. There's always the possibility, of course, that the Fed tries to steer. There's always that possibility of entering recessionary territory as the Fed tries to steer the US economy from 3% inflation down to 2%. It's an inflation target, and achieve that ultimate aim of that soft landing. So what that means is taming inflationary pressures while circumventing a decline in economic activity, namely a recession. All right, guys. So on to the dollar index. As you can see here, we have two charts here, guys. We have the monthly time frame, so we have a very longer term time frame to the left, and we have the daily time frame on the right. Now, for me, as I said, I do not see much demand for the greenback at the moment, and I do not see much going into at least Q1 of the next year. And this really shows on the charts. We have room, as you can see on the monthly time frame. We do have room to drop lower to the 100 level. So support at 99.67 is something I was watching closely earlier in the year. As you can see, it did rebound from the level in July, almost to the point, I believe it was at that time. This will be another level I'll be watching closely, as I'll also be watching this moderate Fibonacci cluster between the 38.2% and 61.8% Fibonacci retracement ratios, which essentially bolsters that support level at around 98.72. But look, if demand really does pull away from the greenback next year, we could take that level out and really take aim at this ascending channel support, channel support here. And this was taken from the low of 72.83 there, guys. Hi, Carla. I can see your question. Which currency pairs am I talking about? This is not actually a currency pair. This is the dollar index. So the dollar index is an index of the dollar's value against 6 major currencies, which includes the euro, the pound, and 6 major international currencies. So this is something I always look at to get a gauge of where the dollar is currently at, in terms of a technical assessment. I hope that answers your question, Carla. I will be moving on to currency pairs shortly. Yeah, so it's really for the dollar. Yes, the dollar outlook. It's a technical dollar outlook. I hope that clears things up, Carla. So yes, look, for me, I do anticipate we will see price test that support at 99.67 and potentially even overthrow that level to target that channel support there. You will note on the RSI, the monthly RSI there, we are now testing that 50 center line there. It's been up and down just above that level for quite some time now. Now, if we do drop below that 50 center line, look what we have just below it. We have a trend line resistance turn support, which could very well see the index turn higher. So this is certainly something I'll be watching closely as we enter Q1 of next year. Now, more near term on the daily time frame, there we have support between 101.44 and 101.74. This is a support that I do anticipate some buyers will be drawn to. Again, when we do test, I do believe we are going to test that area, but ultimately I do anticipate that we will engulf that area. As I said, demand for the buck just really isn't there at the moment, given the clear pivot from the Fed. So I do anticipate we will engulf that support area and make our way towards that monthly support, which I have on the daily time frame at 99.67. So look, guys, to really wrap this up for the dollar index, I do see further selling for the dollar in 2024, at least in Q1, until we test that 100 area, that monthly support at 99.67. Okay, look, the S&P 500 has been an absolutely fantastic market average for me to analyze, because it really worked. It really worked well with technicals since we touched gloves with that. We came within touching distance of that support on the monthly time frame. I'm just going to check I'm sharing that chart there, guys. Yes, I am. So when we tested that support at 4102, sorry, guys, we came within a couple of points of testing 4102, and the daily support, the daily support at 4104. Ever since then, it's been a fantastic market, and it's been one-sided to the upside, guys. And there's been a number of dip buying opportunities as we've engulfed resistances along the way, all of which have been noted in previous analysis released by the team. Now, the big thing really for me is, much like the NASDAQ 100 recently touched gloves with all-time highs, I do see, I mean, if you look at the monthly chart here, you do not need to be a rocket scientist to know which way this market is going. It's to the upside, guys. We have a clear uptrend on the S&P 500, and this is really underpinned by the Fed pivot. The cutting of rates will underpin equities, I believe, at least enough to engulf that all-time high and refresh all-time highs of 4818, if my memory serves me correct, 4818. And so I am bullish still for equities at this point, and this is really reaffirmed on the weekly time frame. So that center chart there of the S&P 500, we have that resistance being challenged at 4743, and I did say in the week ahead report that if we engulf this weekly resistance, we could see lower time frame dip buyers enter the fight. I haven't been to the lower time frames on this in this market, but I do anticipate that we will see breakout buying occur. I also said on the daily time frame, look, if we engulf that resistance at 4725, this could provide an early cue to engulfing that weekly resistance that I just mentioned at 4743. So it's a pretty simple market at the moment. We are clearly to the upside. Everything is pointing to a test of that all-time high. I believe we will see the all-time high before the end of the year, and maybe even reach to fresh highs before the year is out. So this is certainly something I'll be watching closely, and I do anticipate breakout buying opportunities on the lower timeframes in that direction. All right, so moving over to the pound. Now, the UK, we're in a slightly different boat compared to the US, it would seem, in the UK over here. This, of course, is the pound-dollar chart, and it's comprised of the weekly chart and the daily chart there. But look, first and foremost, where are we according to the Bank of England? So just last week, we saw the Bank of England stand pat on rates. They maintained their base rate at a 15-year high. I think it was a 15-year high of 5.25%. And this was a vote of this was a 6-3 vote. Now, the three MPC members that actually voted for the 25 basis point hike were actually unchanged. So it was Megan Green, Jonathan Haskell, and Catherine Mann. As a reminder, there was no press conference for the Bank of England, but we did get some really quite notable takeaways from the release. The policy rate will need to remain in restrictive territory for sufficiently long to return inflation back to that 2% target. Now, one of the key questions many will be asking, of course, is how long is sufficiently long? And could this force the UK's economy into recession, remaining at their terminal levels for so long? So we have no date from the BOE or timeline regarding possible rate cuts. The markets, of course, have their own idea, which I will get to very shortly. Now, in terms of the accompanying statement, we also saw that the decision to increase and pause was finally balanced, and further policy firming would be necessary in the event of, and I quote, persistent inflationary pressures. Now, in a separate statement, we also had the Governor Andrew Bailey, the BOE Governor Andrew Bailey, commenting that there is still some way to go before inflation returns to the central bank's 2% inflation target, which of course is incredibly different. It deviates somewhat from, of course, the Fed's recent meeting. So, would it be fair to say that the BOE is sticking with its tight monetary policy for now, with 3 out of the 9 rate setters voting in favor of another 25 basis point hike? And would it be fair to say that this higher for longer narrative is likely to support the pound at the beginning of 2024? That is the question. Therefore, right now we have an interesting case of the central bank not showing any sign of easing at this point, but from the OIS swaps market, traders are pricing in around 100 basis points of cuts until November of the November meeting of 2024. Last time I checked, there is also around a 30% chance of a cut as soon as March. This is very unlikely, in my opinion, given where we are with inflation. We also have around a 60% chance for in May for a cut, with a rate cut currently fully priced in for June, and that's a 25 basis point rate cut. So where are we in terms of the UK's economy? Look, the UK, much like the US, is in the disinflationary phase. Headline consumer CPI inflation slowed to, I think it was around 4.6% in the 12 months to October, and that was down from 6.7% in September and in August. Look, and really, given that the inflation target is 2% for the BOE, we are still nearly 2.5 times north of this value. Therefore, we clearly still have some work to be done on this side of the pond. Now, services inflation is certainly something I wanted to mention this afternoon. It's proving rather sticky, slowing to only 6.6% in the 12 months to October, and that was down from 6.9%. We must remember that the UK is a majority service-based economy, meaning most jobs revolve around providing services rather than actually creating products. This means that services inflation, of course, has a large influence on the overall inflation in the UK. So for me, really, guys, before the BOE voices anything remotely close to cutting rates, I would think we'd need to see a sizable slowdown in both the core inflation measure, which excludes energy, food, tobacco, and alcohol, and of course the services measure, the services inflation measure. Despite both actually already showing signs of peaking, which I think is from a 3-decade, both are coming off 3-decade highs. So we are seeing a potential peak in those measures. Of note, guys, and this is something certainly I would encourage noting, we do see fresh UK CPI numbers out of the UK tomorrow at 7 a.m. GMT. So do keep this in mind. Now, guys, I really won't add too much here because I want to get to the charts, but I do want to touch on growth and wages. Now, if we compare growth in the US to the UK, which in the UK has largely stagnated. It is quite a comparison. According to the latest data from the ONS, we essentially flatlined in the UK for Q3. Now, do note that this was a preliminary measure. So unlike the US, we only in the UK, we only have two estimates. So we have the prelim and we have the final. And from memory, the final is on Friday. So we have the final GDP for the UK on the 22nd of December. Now, for wages, I mean, I'm pretty sure we're all aware wages in the UK remains elevated. And what I mean by that, regular pay, which excludes bonuses, was more than 7%. Now, I think it was 7.3% between August and October of 2023, and around 7.2% for wages, including bonuses. Now, really, guys, this does not bode well for the BOE, bringing inflation down to target, and that could really stir the stagflationary pot, if you will, meaning elevated inflation and slowing economic activity. Of course, no one knows for sure. We have all of these forecasts at the year end, and most of these, you'll find most of the big banks, their forecasts for the year tend to change within the first couple of months of the new year. So again, no one knows for sure about what's ahead for the UK economy or the pound. My opinion is the BOE appears to be adopting more of a higher for longer stance than the Fed, which could bolster the pound against its US counterparts, at least in Q1 next year. I know economic activity here in the UK is dismal, but the fact inflationary pressures are still double the central bank's inflation target right now, I really can see the BOE holding at least until mid-June, maybe even into Q3, to be frank. But the road is not clear, of course, as stagflation could weigh on the pound, right? It could really cause some issues for the pound, and that could stoke recessionary concerns. It's really a difficult one for the pound at the moment, but for me, I am favouring a higher pound, given that inflation is so high still in the UK. Now, on to the pound dollar. Look, the weekly time frame is just poking its head above that resistance at 26.97. Now, these are key long-term areas of support and resistance here, guys. You'll also note on the weekly time frame, we have the RSI above that 50 center line, indicating positive momentum or indicating average gains are exceeding average losses. Look, if we close above this resistance at 26.97 on that weekly time frame here, I really do believe this will trigger longer-term breakout buying in the direction of around beyond that key 130 level to around 131.34 resistance on the weekly time frame. Now, if we get beyond here, then I see very little at this point here. I just see consumed supply at this point here. Although we may get some resistance form around this area here, but I see a load of consumed supply at this point. And then we have this double top area of resistance calling for attention around the 142 level. So I really am quite positive for the pound heading into the new year, especially if we end the year above this 26.97 level. Now, on the daily time frame, we are entrenched within this ascending channel here. Given what I'm seeing on the weekly time frame, I do think we will test this resistance before the year end, I believe, at 28.34, and potentially overthrow that resistance to target those highs around the 131.42 and 129.96. So I believe it's all to play for the bulls heading into the year end and, of course, for Q1. And as you'll see, but on the RSI for the daily time frame, you will have noticed we just recently had some negative divergence play out. But I really don't think that's going to be a concern for bulls at this point, given that the GBP is underpinned on the fact that the dollar is being sold into at this point. So for me, I really do see that we will have a pound dollar bid for the time being. And this could really open the door to not only breakout opportunities, but also those break and retest setups that often occur on the lower time frames. And you can always use the higher time frame targets to really increase that risk to reward metric. So look, guys, I apologize for the time here. I really need to speed things along here due to the time constraints. So I do apologize for that. So I will shorten the macro side of things for Europe, but I have to touch on some of the key things, of course. So moving on to the euro dollar again, the euro dollar, this is the monthly chart on the left-hand side and the daily chart on the right-hand side. Now, the ECB, again, last week, it was a really busy week for the markets last week. So I think it was Thursday, if my memory serves me correct, we had the SMB, we had the ECB, and we had the BOE all on one day. It was a very, very exciting day for analysts, traders, and investors. So the ECB, alongside the Fed, alongside the BOE, and the SMB, left their benchmark rates unchanged. So 3 key benchmark rates unchanged for a second consecutive meeting. So with the ECB, we have the deposit rate, we have the main refinancing rate, and we have the marginal lending rate. The deposit rate is still at record highs of 4%. The main refinancing rate is at 4.5%, and the marginal lending rate is at 4.75%. Now, the post-rate statement repeated that future decisions will ensure that its policy rates will be set at sufficiently restrictive levels for as long as necessary. For anyone that reads those post statements, you'll also realize that they removed that sentence regarding inflation. So inflation is still expected to stay too high for long. That was removed, and the following sentence was added. While inflation has dropped in recent months, it is likely to pick up again temporarily in the near term. And that was quoted from the statement. Now, projections for headline inflation out of the ECB, so the Eurosystem staff, 5.4% for 2023, 2.7% in 2024, and 2.1% for 2025. And they are all go right out to 2026 and 1.9% in 2026. Growth is expected to remain pretty subdued. 2023, 2024, and 2025. Really, I'm not even. It's 0.6% for 2023, 0.8% for 2024, and 1.5% for 2025 and 2026. Not much really to go on there. What I will add that at the follow-up press conference, and that was 30 minutes after the rate announcement, ECB President Christine Lagarde echoed a similar vibe to Governor Bailey. And when questioned regarding rate cuts, Lagarde responded with, "The bank remains," and I quote, "the bank remains data dependent and not time dependent." Again, and I quote, "We should absolutely not lower our guard," from ECB's Christine Lagarde. Interestingly, though, markets imply that the ECB could cut rates by a whopping 150 basis points next year, which is quite something. With the first rate cut, according to the OIS swaps, could come as early as April. So, look, the Eurozone economy, economic activity has been stagnant this past year. There's no denying that. And growth, as I've said, is expected to remain lackluster in 2024. I'm not expecting anything amazing from that. Inflation, though, is clearly disinflationary, much like the US and the UK. It's slowed considerably since its 10.6% peak in late 2022, and recently, in the 12 months to November of 2023, it's at 2.4%. Now, core inflation has been more sticky, but look, again, it has slowed to 3.6% in recent data, so the 12 months to November, and this was down from 4.2%. Look, wage growth accelerated in 2023, and that essentially made up for past losses. in real income, but the worsening labour market conditions should result in lower wage growth moving into 2024. So look, guys, as we step into 2024, I really feel this year's trade is not about how high rates are heading. It certainly is not about that anymore. It's more about how long they will remain at their terminal or peak rates, how long they will remain in restrictive territory. This is the question on most of our lips right now, and which central bank will snap and begin cutting first. Therefore, central bank easing is likely to be the theme, the major theme for next year. Now, you'll be happy to know I'll stick to the technicals now. I would like to try and get through a couple more charts before the end. So the euro dollar, look, the euro dollar on the monthly time frame is clearly in a downtrend right now, guys. There's no denying that. Again, you don't need to be a rocket scientist to know this. You don't need to flood your charts with the ADX or any moving averages. It's quite simple. We have lower lows, we have lower highs, a series of lower lows and lower highs. It's very, very simple to see. And we have recently seen a pullback, as I noted here, a pullback to the high of, not that it matters too much, 1276, which touch gloves with this resistance at 1233. And then this is a very important resistance for me. And it was something I noted in the technical reports, because it converged closely with that 50-month simple moving average, currently at 1151. This is still a key level for me, and I'm still quite bearish on the euro dollar from a long-term technical perspective. Until that resistance 1233 is overthrown, I'm still quite bearish technically in terms of the trend, because I've seen no change. But if we form a higher high at this point here, and we maybe even retest that resistance as support next year and form a higher low, then that will confirm for me that we are now in an uptrend. I know there are different ways of determining a trend. So we have the golden cross, we have the ADX, we have the moving averages pointing higher. There's a number of ways, but for me, I tend to be quite old-fashioned in that I want to see price action confirm trend direction. So for me, we are still in a bearish trend for the euro dollar, but that could very much change, especially with the US dollar expected to continue underperforming. So really, for me, at least in Q1 of next year, I'll be watching this support at 0.516 closely. I do not expect this to be challenged, but I do expect this resistance at 1233 to be challenged. This will be the key watch for me longer term. Again, if we engulf that, I will be looking at possible bullish opportunities up to these highs here. So I don't see much resistance, much clear-cut resistance on the monthly scale until around those highs of 2350-ish and 2556-ish. So that will be the upside target for me in terms of the euro dollar longer term. Now, if we move over to the daily time frame, look, we haven't seen much in terms of trend direction since the beginning of the year. I think it was February. Yeah, the beginning of February, we've not seen much at all. And as you can see, we have been in an uptrend since, I think it was the beginning of October. The beginning of October, we have seen a series of higher highs and higher lows come into play. Look, if you follow the moving averages, we've also come above those 50-day moving averages, the 200-day moving averages. And if you look at the orange 50-day simple moving average, we are closing in on that 200-day moving average to form that widely talked about golden cross. I'm not a big fan of that, to be frank, but I know some traders do watch that as a potential long-term trend reversal signal. More shorter term, I am looking at this resistance at 0.997. I do anticipate that we will eventually engulf this. This will be this year, I believe, and then we will attack this resistance at around 10.98. Look, if we engulf this, which I expect we will, we are then looking at this resistance at 12.33. So these are the two key levels that I'll be watching before this really opens a door for that monthly level at 12.33. So 0.997, key resistance to be watching, and 10.98. We engulf those two resistances. that would open the door for further breakout buying opportunities alongside the immediate trend on that daily time frame. In terms of the RSI, you can also see that we have recently rebounded from the 40-50 support zone. Now, for anyone that follows the RSI, you will note that in uptrending environments, you will often get those support levels between 40 and 50 form. And these are often looked at as temporary oversold areas, where traders seek divergences, seek bullish, positive divergences from. Because the trend is so strong, it rarely touches gloves with that oversold, the traditional 30 oversold area. Just bear with me, guys. I'm just going to check the... Yes, Carla. May I ask which RSI you are using? So I'm using the traditional RSI. I don't change the default periods on the RSI there. It's all set to 14 periods. I tend to stick with what's the default periods for all my indicators that I use. So yeah, it's the default RSI there, guys. With the trading view though, they have recently added a moving average, which I don't really pay much attention to. I haven't found use in that at all, even though I am a big fan of the RSI indicator for marking momentum on a chart. I hope that answers your question, Carla. Look, guys, so look, I am bullish on the euro dollar, especially into Q1. I do anticipate further upside prices into the year end. Again, guys, keep an eye on those resistances, 0.997 and 10.98. So I do anticipate that we will engulf that key 110 level. That's a widely talked about level, the 110 psychological handle. I do anticipate that once we break that, you will see breakout buyers really come into play at that point. Now, onto gold. Gold has been an interesting market. So gold recently hit or refreshed an all-time high, as you can see here, at $2,148. But at the same time, on the weekly time frame, we formed what's known as a bearish outside reversal. Now, there was a number of traders that noted this as a bearish engulfing pattern. I mean, traditionally, according to the textbooks, that's incorrect. A bearish outside reversal only focuses on the upper and lower shadows, whereas a bearish engulfing actually focuses on just the real candle bodies. So not that it matters, it pretty much, it means the same thing. We've engulfed a previous candle. Just in case you're interested in the textbook style of things. So we have a bearish outside reversal on the weekly time frame here, upon forming that fresh all-time high at 2148. Look, I don't believe that the bearish outside reversal is anything to get excited about, and I don't believe that this will trigger further selling in this market. I believe gold is now in a firm uptrend, and given that the dollar is likely to continue pushing lower, I am looking at further upside, further all-time highs for the price of gold. You will note on the weekly time frame there that I have a resistance at 2,075. For anyone that follows the just bear with me, guys. For anyone that follows the price of gold, you will note that 2,075 was the previous all-time high since late 2020. But this is a key resistance level. I mean, can you just imagine this spike here? Just imagine this is a textbook bull trap, which means above here you would have had breakout buy orders, but you would have also had those traders looking to fade that level, expecting price to drop. And it did drop, but they weren't expecting this spike here, which is effectively a bull trap. So it traps all of those bulls. It traps the breakout buyers, and it also traps those. It also takes out all of those buy stops set by sellers at that 2075 previous all-time high, because previous all-time highs are going to be widely watched by everyone across that market. And it would attract, so if it attracts attention, it attracts orders, and hence we get major spikes like this. And they're very, very nasty if you're caught in one. I mean, if you go down to the lower time frames, if you remember, it was a quick spike. It was a really quick. I mean, look at that. That is insanity. if you got caught in that, I feel for you. I really do feel for you. It was an insane move, and it really caught me off guard. I wasn't expecting that. I was expecting a nice traditional break and retest and potentially a continuation higher. I wasn't trading this market at the time, thankfully. There was no setup for me technically anyway at that point. But yeah, I feel for anyone that got caught on that bull trap there. Look, going forward on the weekly time frame there, guys, I do see, even though we have negative divergence on the RSI there, you can see negative divergence just below that overbought level. Look, for me personally, I like to see overbought signals form within the overbought space. Positive hidden divergence and positive negative divergence is rarely seen in overbought or oversold spaces. But yeah, I tend to look for the traditional negative and positive divergences in overbought and oversold space. Negative divergence is not in overbought space, so I'm really overlooking that, if that makes sense. And I really do think we are heading higher for the price of gold. And I do anticipate if we close above here on a weekly basis, this will attract further buying and we will eventually refresh those all-time highs. Now, will this occur before the year end? That's anybody's guess, right? Given the forceful downside bias of the dollar right now, it could come close. It really could come close. But look, we are in holiday trading. We are leading up to that festive period now, and liquidity generally thins out. So do bear that in mind. When liquidity thins out, that doesn't mean price just stays in one range. It can really open the door to some major market moves, because all of those major players that have left for the holidays, they've pulled their bids, they've pulled their offers, and that opens the floor. Right, so all of those small orders coming in can really move that market, because there's not those big orders to really contain the price movement. So do bear that in mind if you're trading over the holiday period. And this can really see spreads widen as well. So do bear that in mind. Onto the weekly time frame. So the weekly time frame, we bounce from this support at 1989 and 2000. So 2000 is going to be a widely watched level. We've bounced from that level and we've retested the underside of a trend line support turned resistance. I thought we were going to continue. I thought we were going to pull back, correct, and retest that support, but around the 2000 level. But it doesn't look like we are going to. It looks like we are going to continue higher on that daily time frame to retest that 2075 level. So for me, guys, my main watch for the time being is between that support 1989 and 2000, and that resistance of 2075. Breakout buys beyond that 2075 level would be where I'd be watching, targeting that all-time high. And then if we get a close above there, just be careful, guys, because you don't want to be caught in those bull traps. Wait for those retests to play out. That's what I do around key levels. I wait for those retests to play out, and I look for the approach. So I look for an AB equals CD approach. So for anyone that follows harmonics will understand what I'm talking about. An AB equals CD basic harmonic approach to that broken level, and that's where I will look for my entry. So I look for an approach that really matches what's going on with the price action. So that's where I am on gold. Now, Bitcoin against the US dollar, what a crazy market, right? We recently touched $45,000, a $45,000 high, and we can see all the forecasts are already coming out. We're heading for 100K, 200K. No one knows. No one knows where we're heading long term on the price of Bitcoin. We really don't. It's quite impossible to know where we're heading longer term on the price of Bitcoin. All you can do is analyze price action, analyze the underlying fundamentals. Really, for cryptocurrencies, I don't really understand that if there are any fundamentals that I could use other than it's traded against the US dollar. So the US dollar is expected to continue pushing lower based on that Fed pivot, right? Based on the expectation of a Fed pivot and BTC USD. So if we see that the dollar weighed, this could underpin the price of Bitcoin, which was the case in recent trading. Now, technically, what I'm watching right now on the weekly time frame, so that chart on the far left, I'm clearly watching that support still at 38,523, and that resistance zone. That is a key area of resistance for me, comprised that consists of a 61.8% Fibonacci retracement ratio at 48,565, a resistance at 47,115, and that 1.272% Fibonacci projection at 46,112. Now, the Fibonacci projection, for anyone that does follow the AB equals CD formation, will note that that's also an alternate AB equals CD formation. Alternate AB equals CD formation. The RSI, look, is considerably overbought. It's touching levels not seen since early 2021. So, and if you look closely at the price action of the weekly time frame, it looks like we're almost forming a bullish pennant. Now, if that thing breaks to the upside, we could see some sizable moves occur. But look, I am bullish Bitcoin. I am bullish Bitcoin given what's happening with the US dollar. So Bitcoin against the US dollar, I am bullish. And I do see us testing that resistance area just mentioned on the weekly time frame sometime soon, despite the RSI testing overbought. So one thing I will say about the RSI, guys, the RSI can remain overbought for prolonged periods of time, and it can really give a number of false signals exiting that overbought threshold of 70, because it remains within that we're in a strong uptrend and it remains within that overbought threshold, but keeps snapping below it and producing so many false signals, and it can result in a number of losses. So do bear that in mind. We are in an uptrend on the weekly time frame, and we are in an uptrend on that daily time frame. Now, moving over to the daily time frame, I'm not sure if anyone was watching or follows the Pattern Pulse release that's released every Thursday. I highlighted that ascending channel there, and it played out to a T. It was a fantastic pattern to watch, and it was very easy to highlight, very easy to see. I mean, a clear-cut ascending triangle, excuse me, which are generally considered continuation patterns, and we broke out to the upside early December. So it was a fantastic trade for anyone that traded on the back of that, and we broke out and we easily reached the profit objective. So for me, on the daily time frame, the 41,500 level of support is a key watch for me right now. I would be surprised if we cleared this level, because if we clear this level, then that really opens the door to that support down at 37,624, which is below that monthly support. So if we break below 41,000 on the daily, I really do expect we will return to that monthly support at 38,523, which could open the door for a retest trade, or as many will say, a dip buying opportunity for the price of Bitcoin. So that's where I am right now. So I'm looking at that resistance area on the weekly time frame between 48,565 and 46,112, and support at 38,523. Again on the weekly time frame. But for the daily time frame, the key watch for me, guys, is that 41,500 level. We break below that, then we can potentially open bearish short-term opportunity. It could potentially open bearish short-term opportunities towards that monthly support at 38,523. But at which point I'll be looking for that dip buying opportunity to target higher levels based on what we're seeing in the US right now in terms of the Fed. Guys, are there any questions regarding what I've... Sorry, guys, I'm actually losing my voice, I think. So that really is all we have time for today. If there are any questions, do fire them across. I've checked the box. There's nothing in there. So I assume we understand everything I've said, and maybe agree, maybe disagree. I'm not sure. Feel free to let me know. That's what makes the market great, in my opinion. We can both have different opinions, but we can all make money. Look, as you can see, there will be plenty to get our teeth into in the new year, with a number of trading opportunities potentially opening up based on that central bank easing theme. Again, if there are any specific topics, as I say in all of my presentations, you would like the team here to talk about, or questions related to this presentation, feel free to reach out to us with suggestions at marketanalyst@fpmarkets.com, and the research team will get back to you as soon as possible. We also have the Trading Hub, which is packed with educational articles and analysis. So please feel free to visit there. We also have the Academy, the FP Markets Academy. All the links will be seen in all the links will be seen should be seen in the chat box there, guys. Bear with me. The support team should be loading those up as we speak. We also have, as I said, the Academy. Please do consider going along to that, especially if you're a new trader. We have a truckload of videos and in-depth articles explaining the basics, so you don't have to search around different websites. It's all there in one place for you guys to begin learning about trading and investing. We have a Telegram channel. That's a very active channel. Feel free to head along to that. Again, the links should be in the chat box. I'm just checking the chat box as we speak. Bear with me, guys, but the links should be there soon. I'm just going to check. There's a question there, guys. Please touch on the Xmas rally on indices. I don't know what you want me to say, really. It's quite impressive. What's going on? The Santa rally, right? I don't know what to say. I mean, we reached all-time highs on the Nasdaq 100 in recent trading. We're almost reaching new highs for the S&P 500. It's quite an insane time, really. Insane but exciting at the same time. And yeah, I just think, really, guys, rate cuts are on the horizon, which technically should bolster those indices further. But with recessionary fears also coming into play, we could also see notable corrections in those indices as well. So do bear that in mind. Thank you very much for your kind comments there, Sandil. I really appreciate that. And I do agree with you. Rate cuts are a shadow. That's well put. Well put. Do I teach basic price action? Yes, there. As I said, in the academy, there we have a number of videos on the basic price action. So when you talk about price action, I'm referring to basic support and resistance, how to locate that. Because look, support and resistance there's a number of things you can use for basic support and resistance. You can attack that objectively. You can look at round numbers. You can look at pivot points and things like that. You can also look at the moving averages, right? But you can also look at other different things, which is where it becomes more subjective in terms of support and resistance. And support and resistance, let me just say, is the backbone for many technical-based trading strategies. So it's a must learn. It really is a must learn for technical traders. Bitcoin, I've just got a comment here. Bitcoin halving in April also. What's your take? I have no idea what that is. I've not read about that. What's my take on the BTC ETF? Not much, to be quite honest with you. I just focus on the price action. And again, I don't really follow Bitcoin other than the price action there. I don't really see the need to follow Bitcoin anything else, really, to be quite honest with you. Of course, I really am a fan of the macro side of things for the FX space, but as far as Bitcoin or cryptocurrencies, I tend to stick away and just analyze the price action, because it's really a technical based market for crypto. For me, in my experience, it's really a technically friendly market, because I think a lot of retail traders trade this market as well, and it has an effect in terms of technicals for me anyway. That's what I've found. Where do you teach technical analysis studies? There should be a link in the chat box. Just bear with me, guys. I'm just going to try and find out what's happening with the links. Just bear with me, and I'll just find out. There should be in the chat box all of the links, but yes, there must be an issue with the support team at present. Look, what I can do is, if you can email me, Ali at marketanalyst@fpmarkets.com, I'll make sure I send over all of those links tomorrow if that's okay, and you can then access all of the academy. But the links are normally in the chat box for you to access. Any other questions, guys? Oh, chat is disabled. I'm not sure. The links are there, are they, Nicola? I'm sorry if I've pronounced your name wrong. Chat, yes, Ali. I think chat is disabled for me as well, but some people are saying that the links are there. I'm not sure what's going on with the Zoom at the moment. I apologize for that. The only thing I can really say is if you can email me at marketsanalyst@fpmarkets.com, and I'll make sure first thing tomorrow I'll have those links sent to your email. Any other? Oh, the links are there now. Now it's working. All right. That's fantastic. Excellent. I still can't see it, but I'm not sure. As long as they're there, that's great. As long as you can access all of those links that we were discussing, that's fantastic. All right, guys, are there any other questions before we end the presentation? All right, so I take it as no. Look, thank you very much for taking the time to join us. I really do appreciate it, as does the FP Markets team. I wish you all a very, very Merry Christmas once more, and a Happy New Year. And look, I'll see you all again in the new year. So safe trading over the holidays. Please do bear in mind that the spreads will widen across the board because of all those interbank players taking those holidays. Spreads widen across the board. So do bear that in mind, guys. All right. So thank you very much, and have a wonderful festive period if you celebrate. And I'll catch you all again in the new year. Thank you so much, guys.